Godrej Consumer Products. Thanks for joining into this conversation with Godrej Consumer Products. Their revenue numbers were ahead or largely in line with Bloomberg estimates. Margins went up on a YOY basis, even though one may argue that on a line item basis, they were lower than what Bloomberg was estimating. But brokerages are very constructive with what's happened in quarter one, as according to them, it gives you a sense of what could happen in the quarters to come. The company on its part, at least on the con call, is optimistic about the EBITDA margin commitment for FY24. Let's get in Mr. Sudhir Sitapati to talk about how he thought the quarter went by and what is the promise for the quarters ahead. Mr. Sitapati, good having you. Thanks for taking the time out. Hope all is well.
Thank you.
How would you sum up the quarter? Because, as I said, relative to Bloomberg estimates, maybe on the EBITDA margin front, there was a bit of a miss. But YOY on all line items, you've done better than what you did in the corresponding quarter.
Yeah, I mean, we look at the quarter slightly different from estimates. I think for us, what's heartening about the quarter is our organic volumes are up double digit in India and almost double digit globally. Our Indonesian business, after several quarters of a tough time, has turned around. And our EBITDA margins, again, organically, because we do have this impact of the RCCL acquisition, but organically, our EBITDA margins are similar to what they were pre-COVID, which is our historic high, which are very different shape, which lower gross margins, higher advertising, but lower costs. So these things, our cash flows are excellent. Our cash flows are at record highs. So these things make us pretty happy about the quarter just gone by. Though one must say that we were aided a little bit by a good household insecticide season, because summer wasn't, as you must have heard from many other companies, summer wasn't as hot as it usually is. So I would say a little bit of a tailwind in terms of seasonality, but nonetheless a good quarter for us organically. We're also happy with the progress on the Raymond integration, which is more qualitative. We have taken whatever losses and whatever had to be done in quarter one. We will continue to do it in quarter two, and really from H2 onwards, we expect that business to accelerate.
And I'll come to Raymond as well in just a moment. But first, this small changes because there was maybe a price reduction in soaps, and you could argue that revenue could have been a tad lower there. But the volume growth at 12% YOY and organic 10% is heartening at a point of time when companies are giving very mixed commentary about what's happening in rural per se. So I would love to understand from you, what do you sense this quarter indicates for the quarters to come, especially as we enter a monsoon quarter, so to say, and then a very busy second half?
I think the issue on rural demand remains. It's not that demand conditions are easy in India. I think we have done well, as I said, partly because of a little bit of luck, but also partly because if you see, for example, our working media, which is above the line, spends in advertising are up 70%. We are now one of the largest advertisers in the country. So, a lot of this has just been driven by a lot of investments, both above the line and in terms of sales, which we think is trumping relatively tough market conditions. So I think that commentary is not incorrect. I think we have been able to, go a little bit ahead of that due to kind of investing. In particular, last year we had difficult results, but because macro conditions were tough, but we persisted in investing, and I think that's paying back now.
Would you therefore say, Mr. Sitapati, that it is kind of difficult to predict what could happen in terms of demand per se? While I have noticed that on the call, you've given fairly confident commentary about your operational metrics.
Yeah, I mean, this definitely there is a worry that, one can see, green shoots and silver linings and whether it's doing, but definitely the kind of buoyancy that was there in rural prior to COVID, we have yet to see that buoyancy come back. Urban is doing well for us, and for, I think, the market, everyone is quite happy with it. I don't know, I'm not an economist, I can't really predict when that buoyancy will, but I think the important thing is, regardless of the macro conditions, you can spread the market quite well through category development and building the categories that you are operating in. So while macro, stuff makes a difference, there's a lot more in our hands to see how we can grow faster than the market.
Okay. Now, you admittedly had a weak Q1 in some sense, but you were happy with the start to Raymond. But despite this, you were also guiding towards the flat revenue growth and high single-digit EBITDA. Now, what gives you the confidence on that piece?
No, I think you see, while the Raymonds we have taken, we've had Raymonds for a month and a half, firstly, in our stable. We have taken back a lot of stock, reduced a lot of stock at distributors, changed the credit terms, so done a lot of things which will admittedly have an impact on business, but we're doing the right fundamentals, and we've seen in category after category on our core GCPL business that when you do the right fundamentals, you will get the results. So it is better in some of these things because our thesis on Raymond's has not changed, certainly in the last 2.5, 3 months, which is these are good brands and they, there's a lot of synergy with GCPL and they need to get onto our machine. So the quicker we do it, the quicker we take the losses rather than try to, maximize in quarter for what we know needs a surgery. It's better for us to do it in the first 3, 4, 5 months and then move on. And that's what we're going to do on Raymond. So it's going to be another tough quarter this quarter because there is more to be done. I mean, to give you a perspective, Raymond's distributors sit on 80 days of stock. GCPL distributors sit on 10 days of stock. That's the kind of stock difference. It's a different business model. So those have to be corrected or are certainly brought to our norms. And that will mean a hit for another quarter. And we hope by second half, we really see the might of GCPL on this business.
Okay, cross fingers for that. Mr. Sitapati, a word on the global side as well, because encouraging second quarter in a row for Indonesia. Nigeria has these currency issues. Sum that up for us, please.
I think Indonesia, and let me just take a step back. I think Indonesia is good because the macros in Indonesia are good. And our business, after having a bit of a rocky patch, has corrected a lot of the things and is doing well, both in terms of market share and in terms of our internal process. So I'm quite reasonably bullish with the prognosis of Indonesia. I mean, I can't predict how the economy will do, but we're quite happy with that. Nigeria, I mean, it's a very, very large and steep devaluation of the Naira from 450 Nairas to the dollar to now free floating at 750 or even 800 Nairas to a dollar. That has its short-term impact. In the medium term, we're quite happy with that move because it becomes a level playing field. And, you just price for the currency and there is no more, how much currency do you get at the official rate? What is the allocation? What is the quota? All that is gone. So in the medium term, it's a good thing. The Nigerian economy is fundamentally a vibrant economy, actually. It's a large consuming class. And we hope that this, matching of the official and unofficial rates is good in the long term.
Okay. I know we run out of time, but I'll just take the liberty of asking one more question, Mr. Sitapati. The belief largely was that the second half of the current calendar would be a marked lower inventory cost quarter because of falling commodity prices. There is a slight tweak in that by virtue of what the Saudis have done with regards to crude, or if a China reopening happens even in a greater fashion with some stimulus, then what it could do to commodities. Are you bracing yourself for an uptick there, or do you reckon that largely things should remain stable to maybe positive on the input cost front for you as a company?
I'm not an expert on the subject, Niraj. It doesn't look like a hyperinflation. See, we worry about commodities. If they become hyperinflationary or hyperdeflationary, you have to do something about it. It looks like in the last few weeks, palm oil, which is the main commodity that we buy, but also crude, I mean, has seen some kind of uptick for the reasons that you mentioned. But it is certainly, it's in the realm of, it's not in the realm of, requiring actions that are very radical. So it doesn't appear to me, you must speak to my colleague Dorab, who is the expert on commodities, Dorab Mistry, but his own prognosis is that there might be a slight strengthening of commodities compared to the low base, which is not a bad thing, by the way. A little bit of price growth in commodities is not a bad thing, is what he expects, but we are and we don't expect hyperinflation this year. So we're okay.
Fair call. I know I've run out of time, so I'll call it a day here, but looking forward to a slightly more detailed conversation the next time. Thank you for taking the time out and being with us today.
Thank you, Niraj. My pleasure. Thank you so much.
I appreciate viewers. Thanks for tuning in.